Welcome back to Renegade Investor Academy, where we try to help you see what's really going on out there so that you can make the smartest possible decisions for yourself and your family's long-term financial future. Now, back in the 1980s, Maggie Thatcher introduced something called the poll tax as a replacement for local authority rates. There were riots in the streets, there were cars on fire, there was shops being looted. It was a massive, massive pushback from the population who said, we don't like the idea of a poll tax. Around the same time, there was nothing short of a revolution in the pensions world, and it passed by with barely a whimper. What happened was, we all basically changed from having something called a defined benefit pension, where you know what you're going to get typically as a percentage of your final salary, to what they called a defined contribution pension, where the only thing that's certain is how much you put in. After that, you're on your own. And ever since the 1980s, pensions have been a political football. And they're back in the news now as we look at how the government, and particularly the Chancellor, are going to respond to all of the money they've had to spend dealing with a certain pandemic that we shan't mention, how they're going to claw any of that back, and where's the lowest hanging fruit? Where are the softest targets? That's why they go for people like landlords who own properties. And it's also why they go for pensions, because that's where the money is. So if I talk about pension tax relief, which is the big issue at the moment, in total it's something like £37.2 billion a year. So yeah, that's a pretty chunky number, and that is spread between taxpayers who would typically get tax relief at their level of income tax that they pay, which could be 20%, 40% or 45%, and employers who get some tax relief and also national insurance relief, because effectively you're being encouraged to save that part of your salary. So the reality is you're kind of getting back the tax you would have paid on that income if you hadn't saved it. So if you're a high earner, you'll get a higher rate of tax relief, 40%, 45%, whatever. The other factors, of course, in a pension are how much you're allowed to contribute each year, which used to be unlimited. Then it was limited to £250,000 a year. That's gradually been brought down to just £40,000 a year. As well as a limit on how much you could contribute, they also had this idea of introducing a lifetime limit on the maximum amount you could have in your scheme. Why on earth would you want to limit the amount that somebody can save to make themselves financially independent of the state in their retirement? You'd have thought that was a good thing, but apparently it's a bad thing. And I'm obviously a very stupid person for not realizing that. So they introduced a cap which originally was a few million. It wasn't too bad, but that's gradually been eroded to where it's basically £1 million plus a little bit of official inflation. I think the number technically now is 1,073,000. Now, do you know what the average income is at the moment? It's about 28,000 a year, something like that. Do you know how much you'd have to invest in something like an annuity to buy you an income of 28,000 a year? Well, believe me, it's way more than £1 million. So we have already an issue where people are being forced legally to have no more in their pension than would provide a modest income for them in retirement. And it gets even worse. If you're a high earner earning more than 200,000, the amount you can contribute each year comes down to as little as £4,000, which is, rounding error. It's meaningless. So, and of course, because the bigger earners get a bigger proportion of the tax relief, which remember is only giving you back the tax you would have paid on the income, there are cries that this is unfair, that people on lower incomes get a lower proportion of the tax relief. Well, of course they would. It's simple mathematics. But it's enough to make the Treasury propose a new system of a flat tax relief of perhaps 25% for everybody. And of course, when you position something like this, particularly when it most impacts wealthier people, you can imagine it's highly politically acceptable because it's leveling the playing field. It's making it fair for everyone, so everyone gets their fair share. Oh no, it isn't. And also, it has all kinds of unintended consequences. So let's start by looking at the last relics of the defined benefit scheme. There are still 6.3 million people in the public sector who are in defined benefit schemes. Now, these are completely unfunded. There's no enormous pot of money somewhere waiting to pay all of these civil servants and bureaucrats when they eventually retire. It gets paid each year out of that government department's income. So if the tax relief to them goes down, there's suddenly a funding gap. So they've either got to reduce the services they provide to the public to meet their commitments to their pensioners, or guess what? Someone else has to pay more tax to make up that shortfall. I wonder who that could be. There are actually still about 1.2 million people in private sector defined benefit schemes. You might say they're the lucky ones, but even there's a £280 billion funding gap. And any reduction in tax relief would make that funding gap worse. So companies would have to put more money into their pensions. You might have heard of the impact of things like COVID-19 and Brexit at the moment. I'm sure they're really, really happy about the idea of also having to find more money for their pension schemes. And many of them probably this would be the last straw, and they would just close those schemes down. So clearly, the complications, the unintended consequences of something like this are enormous. But here's the joke. The government doesn't actually know who gets these tax reliefs and where they're all going. So they have asked HMRC to produce a report which will be ready at the end of 2021. So we've got a year to wait for that report, but the decisions on pension relief are probably going to be made in April, or announced in April of 2021 at the next budget and the next financial statement. So what's going to happen? Well, we don't know. Another impact of all this, of course, is in the NHS. You may have heard of the doctors refusing to work extra hours. Well, you can't really blame them because not only were they not getting paid for it, the implications of the automatic pension contributions for the overtime they worked were actually that they had to pay money back in tax relief they were no longer entitled to. So it was costing them money to work the extra hours that the NHS needed them to work because they were short of doctors. What kind of harebrained scheme is that? That again would only get worse if those reliefs were reduced. So there's a lot of complexities in the defined benefit world, but then of course we've got what most of us are in, which is defined contribution pensions. Effectively, since the 1980s, we've all become our own fund managers, our own investment managers. And we have to make the decisions on how we deploy the funds in our pensions that will actually ultimately determine their performance. And typically, we're in things like SIPs, self-invested personal pensions. And occasionally, if you're a company owner, you come across people who have something called a SAS, a small self-administered scheme. Now, one of the penalties of all this is, of course, that you might make bad investment decisions that mean your funds get nowhere near that lifetime limit. But what if, say, 10 years ago, you'd had 100,000 in your pension and you'd put it into Tesla shares or the FANGs? You could easily find that that 100,000 has gone up to above $1 million by now. And anything above that lifetime limit is going to get penalized with a 55% tax charge. So your success in making the most of your investment is penalized by this artificial politician-introduced limit of just over £1 million. So not only have you become your own fund manager, you've now got to manage the performance of that fund to keep it below this threshold, which is only going to increase in line with inflation. They're not going to suddenly double or treble that limit. So what a weird, wacky scenario that is. The Tories themselves, a couple of years ago, came out with a statement that pensions should be simple, transparent, the responsibility of the plan holder, we kind of know that bit, sustainable, and help the economy to grow. Only to a certain extent, obviously. If it grows too much, you're going to get whacked for it with tax. But that's what they said pensions should be. Now, pensions are anything but clear and simple and transparent and all the rest of it. But boy, do you own it. And it's your problem and my problem to make it work. So if they don't go for the flat tax, what are some other options that they could look at? Well, in the past, it's almost, you can see why. I mentioned the 40,000 limit and how far down that's come. It's so much easier simply to reduce that figure than to implement something like a flat tax relief across the whole piece for all the reasons I've already mentioned. So there's a lot of talk about whether that's going to get reduced from 40,000 down to 25,000. And of course, if they do that, it'll be so much harder to ever actually get to that lifetime limit of $1 million because you're starting with so much less that you can actually contribute. So one option would be a significant reduction in the contribution. Another option would be to reduce the 25% tax-free lump sum that you can take out of a pension. So at the moment, assuming you got to the lifetime limit of just over $1 million, you can actually take out 268,000 tax-free. And of course, the pension freedoms of 2015, introduced by that nice Mr. Osborne, have made a lot of people much more ready and willing to take money out of their pensions, which is usually a pretty bad idea. Because don't forget, anything that you've invested within that pension can grow tax-free. Once you've had that tax-free lump sum, everything you take out of a pension is taxable just as if it was a salary. And so you can start becoming a higher rate taxpayer again just with the money you're taking out. So you have these choices between investing in annuities or doing drawdown where you have a certain percentage you take out each year. And again, you've got to really manage that carefully or you're going to run out of capital. But it's quite likely that they could reduce the 25% tax-free lump sum or reduce the annual allowance that you can put in there. Some are saying this is kind of a tax on aspiration, that they're almost wanting to remove the idea that you would want to save a decent lump sum to fund you and your family's retirement. They're certainly not making it easier. They're certainly not encouraging it with this. So what actions can we take between now and the end of this tax year when all of this potentially could come in? Well, the first and I suppose the most obvious one is to maximize your current contributions. And don't forget, contributions can be taken back a couple of tax years as well. Now, I need to caveat this. We are not tax advisors. I'm not authorized to give tax advice. You must get independent advice and expertise. You must talk to your accountant about this. So caveat, caveat, caveat. But one of the things you could do is maximize your contributions, and not necessarily just for this year. If you didn't maximize them last year or the year before, there might even be, I think they call it carry back. So you could actually potentially put 2 or 3 years worth of allowances in and get the maximum relief while you still can. The other thing you could do, and this for me is the best kept secret in the world of investing, certainly if you're tax resident in Britain and you own a limited company. And that is what I briefly mentioned before, the small self-administered scheme. These are brilliant. Because yes, you still have the poxy little amount you can put in and you still have the lifetime limit, but in other ways, they're so much more flexible. For example, you could have a really good year in your business and you could actually transfer more than 40,000 into that pension to kind of just shield and shelter that profit. And then you can actually invest it within the pension. And it's there's a term for it, I think it's called unallocated allowances or something. You can put more than the 40K in and then use up the 40K in the coming years. If you need to have some of that money back in the business, you can make a loan from the pension to the company at a reasonable rate of interest and effectively provide funding to the business from your pension and have interest paid into your pension. Obviously, the same as you can with a SIPP, you can own commercial property in it. So if you want to own the office that you trade from and have rent paid from the company to your pension, you can do that. You can make loans to third parties. There's all kinds of things you can do in a SAS that you can't do in a SIPP. And yet every single week I talk to business owners who have a SIPP and have never even thought about a SAS because most accountants never even mention it. There are only about 4,000 to 5,000 SAS schemes set up every year. There are 5 million limited companies in Britain. So only 1 in 1,000 business owners is using the SAS vehicle. So if you do run a company, get yourself a SAS. We can put you in touch with our own preferred SAS provider if you want. If not, just research the market and make your own decisions. But it's absolutely the best thing you could do from a pension perspective if you can. The other thing is to think about having a portfolio outside your pension. Because if you want a comfortable retirement, you're probably not going to be able to fully fund that within the latest restrictions on pensions, which, let's be honest, they're only going in one direction. It's only going to get worse. The limits are going to get lower, the contributions are going to get lower, the taxes are going to get higher. So the difference between having assets in a pension versus having them perhaps in what you might call a family investment company become negligible. And there are no limits, no lifetime limits, no contribution limits on an investment company. So maybe the answer is that you have your pension, but you also have a separate investment vehicle that you fund from your salary or your business to actually make investments on your behalf. The point is, something is going to change about pensions soon. We've been thinking this would happen for some years and it keeps getting put off. At the very least, I think we'll see changes to the contributions and the tax-free lump sum coming up soon, possibly changes to more of a flat tax relief. So the answer for smart investors, as ever, is to get your retaliation in first. Take the steps that you can now, today. You've got 3 months or so to do it so that you can minimize the impact of whatever Rishi Sunak's attack on pensions ends up looking like. I'll see you next time for another Renegade Investor Academy.